Welcome to the No House Podcast, where money talks, policies shake the economy, and we decode the financial systems that shape your world. I'm your host, and in today's episode, we're diving deep into a question that affects everything from your grocery bill to your mortgage rate, from interest rates and money supply to powerful tools like quantitative easing. We're breaking it all down in simple language, no jargon, no BS. So whether you're a student of finance or just tired of prices going up, stick around, because this episode could change the way you think about money forever. Let's get into it.
Okay, so let's talk about something I think probably everyone's feeling lately. You know that moment you look at your grocery bill
Mhm.
and you just kind of stare.
Oh, yeah. That feeling. Or maybe it's the rent notice or just seeing house prices.
Exactly. It feels like everything's just, well, climbing. And you
Mhm.
can't help but ask, why? Why is this happening?
It's the big question, isn't it? And usually the answer, or at least a big part of it, comes back to this really fundamental economic force, inflation.
Right, inflation.
Yeah.
And that's exactly what we're doing today. We're going to pull back the curtain on this really vital thing that often feels kind of invisible. This deep dive is all about inflation, what actually causes it, which is more complex than you might think, and the powerful group trying to manage it all, your central bank.
Yeah, and we've really dug into a lot of sources, a lot of research, our notes, trying to give you a shortcut to understanding this thing that affects us every day. We want to focus on what you need to know and really why it matters.
And the aim here isn't just, textbook definitions. We want you to actually get how central banks try to control inflation. What tools do they actually use?
Exactly. And we'll look at some real-world examples, too. Times they got it right, maybe times they struggled a bit. And crucially, what does it all mean for you? For your budget, your savings, your job?
Okay, let's dive in then. We probably should start with a quick refresh, just the basics. What is inflation really at its core?
At its simplest, it's just a rise in the general level of prices. But yeah, that simple definition, it hides a lot.
It definitely does. It's rarely just one single cause, is it?
No, absolutely not. Economists usually talk about three main types. The first one is demand pull inflation. You can sort of think of that as, well, too much money chasing too few goods.
Okay, so basically, everyone wants to buy stuff, but there isn't enough stuff to go around, so prices go up.
That's the essence of it, yeah. When overall demand just outruns the economy's ability to supply.
Got it. What's the next type?
Then there's cost push inflation. This happens when it just costs more to make things. So businesses have to raise their prices.
Like if oil prices shoot up, or maybe the cost of computer chips, or even wages.
Precisely. Those higher production costs, they often get passed straight through to us, the consumers.
Okay, demand pull, cost push. What's the third one?
The third one is kind of interesting. It's called built-in inflation. People often talk about the wage price spiral here.
Wage price spiral, right? How does that work?
Well, this one isn't really about an initial shock like the other two. It's more about expectations. So workers see prices going up.
And they ask for higher wages to keep up. Naturally.
Exactly. But then businesses facing those higher wage costs might raise their prices again to cover them. And round it goes.
So it's like a feedback loop, kind of baked into expectations.
That's a good way to put it. Yeah, baked into the system.
So we should be clear. A little bit of price growth is usually seen as normal, even healthy for an economy, right? We're talking about when it gets sustained, significant.
Yes, exactly. Low, stable inflation is generally fine. It's when it takes off that it becomes dangerous.
And beyond the obvious, your money just doesn't buy as much. What are the deeper dangers? What makes inflation so, well, damaging?
Well, one big one, maybe less obvious, is how it hits savers. Think about it. If your savings account earns, say, 1% interest, but inflation is running at 5%.
Your money's actually losing value, even though the number looks the same or slightly bigger.
Exactly. Your real wealth, your purchasing power is shrinking. And that can actually, discourage saving altogether. Plus, high inflation creates massive uncertainty.
How so?
Businesses get really hesitant. They don't want to make big investments, hire more people, expand, because they just can't predict their future costs or what prices they'll be able to charge. And that uncertainty, it really stifles economic growth.
Yeah, it really is like a silent thief, isn't it? But here's the counterintuitive part. You hear falling prices, deflation, and think, great, cheaper stuff. But economists say that's actually really bad too. Why?
Yeah, that's a common first reaction. But widespread, ongoing deflation, it can be brutal for an economy.
Why? What happens?
Well, think about it. If you expect prices to be lower next month or next year, Why would you buy that new car or that new appliance today?
You'd wait. Everyone waits.
Exactly. Consumers delay spending, businesses delay investing, demand just dries up. And that leads to this downward spiral, falling profits, companies cutting jobs. It's a really nasty cycle and historically very hard to break out of.
Okay, so just to really nail this point home for you, our listener, think about this. Say your salary goes up by 3%. Nice, right? But what if inflation is running at 5%?
Are you actually better off?
No, you're worse off.
Yeah.
That 2% difference means your real income, what you can actually buy, has shrunk. It really shows why this price stability thing isn't just jargon.
Absolutely. Which brings us neatly to the institution that's supposed to manage all this, the central bank.
Right. What exactly is a central bank?
Fundamentally, it's the institution right at the heart of a country's financial system. Its main jobs are usually controlling the money supply, influencing interest rates, and often looking after the overall stability of the financial system.
So big responsibilities. What are their main goals, typically?
Well, the big one, almost universally, is price stability. Keeping inflation low and predictable, that's paramount.
But not always the only goal, right? I know the U.S. Federal Reserve, the Fed, has what they call a dual mandate.
That's right. The Fed aims for price stability and maximum sustainable employment. That's quite different from, say, the European Central Bank, the ECB.
How so? What's the ECB's focus?
The ECB's primary mandate is very clearly price stability. That's their main target, sometimes leading to different policy choices compared to the Fed, which has to juggle both inflation and jobs. Central banks also often play a role in keeping the currency stable.
And these banks, they weren't just created overnight, right? There's a history here.
Oh, definitely. Institutions like the Bank of England, the oldest one, then the Federal Reserve in the U.S., the ECB more recently, they all evolved over time, often in response to financial crises or specific economic needs. But the common thread was the need for some kind of central authority for stability.
And how do they approach this job today? What's the modern strategy?
Over the last few decades, what's really taken hold is inflation targeting. Basically, the central bank announces a specific target for inflation, often around 2% in many developed countries, and uses its tools to try and keep inflation near that level. It helps anchor expectations.
Okay, so they have this target. How do they actually hit it? What's the main tool they use?
The primary lever, the one you hear about most, is the policy interest rate, sometimes called the base rate, or the federal funds rate in the U.S.
And changing that one rate
Yeah.
somehow ripples through the whole economy.
Exactly. It's all about the transmission mechanisms. When the central bank raises its policy rate, it becomes more expensive for commercial banks to borrow money from a central bank or from each other.
And they pass that cost on.
They do. So the interest rates on loans for businesses, mortgages for home buyers, credit cards, they all tend to rise.
Which means less borrowing.
Less borrowing, yeah. And therefore, less spending, less investment. It acts like a brake on the economy, slowing things down to cool inflation.
Okay, that makes sense. What about the currency effect you mentioned?
Right. Higher interest rates can also attract foreign investment people wanting to put their money where it earns a better return. That increases demand for the country's currency.
Making the currency stronger.
Exactly. And a stronger currency makes imported goods cheaper. If imports cost less, that also helps bring down overall inflation.
It really does sound like driving a car, like you said before.
It's a common analogy. You're trying to keep the economic engine running smoothly. Use the brakes, higher rates, if it's overheating with inflation.
But don't slam them on so hard you stall into a recession.
Precisely. And don't keep your foot off the brake, low rates, for so long that things run away from you. It's a constant balancing act.
But it's not instant, right? You raise rates today, inflation doesn't just disappear tomorrow.
Absolutely not. That's a crucial point. There are significant time lags. It can take months, sometimes even a year or more, for the full effect of an interest rate change to work its way through the entire economy and actually impact inflation numbers.
Which must make the job incredibly difficult. You're always aiming at a moving target based on data that's already old, and your actions won't have their full effect for ages.
One of the biggest challenges they face, definitely.
You mentioned the Fed earlier. Is there a classic example of this interest rate tool being used really forcefully?
Oh, the textbook example is Paul Volcker at the Fed in the early 1980s. Inflation in the U.S. was sky high, double digits, really entrenched.
What did he do?
He basically slammed on the brakes, hiked interest rates to unprecedented levels. The policy rate went above 20% at one point.
20%. Wow. Did it work?
It did work. It broke the back of inflation. But the cost was enormous.
A recession.
A very deep and painful recession. Unemployment soared, businesses went under. It was a really stark demonstration of how powerful, but also how blunt this tool can be.
And a major lesson learned, presumably, about maybe acting earlier?
Absolutely. It really underscored the danger of letting inflation get out of control and the painful measures needed to rein it back in. It emphasized acting preemptively if possible.
Okay, so interest rates are the main tool, the big lever, but central banks have other things in their toolkit, right? It's not just the one option.
No, definitely not. Another major one is open market operations, or FOMOs. This is probably the most frequently used tool day to day, actually.
Almost. What does that involve?
It's basically the central bank buying and selling government bonds or other securities in the open market.
Okay. How does buying or selling bonds affect anything?
Well, when the central bank buys bonds from commercial banks, it pays for them with newly created money. That injects cash or liquidity into the banking system.
Making it easier for banks to lend.
Exactly. Encourages lending, potentially lowers shorter-term interest rates, and when they sell bonds, they take money out of the system, which tightens conditions.
All right, FOMOs.
Oh, what else? There are also reserve requirements. This is the rule that says banks have to hold a certain minimum percentage of their deposits in reserve, basically cash in the vault or at the central bank. They can't lend it all out.
And the central bank can change that percentage.
They can. If they raise the reserve requirement, banks have less money available to lend, which tightens credit. If they lower it, banks can lend more, loosening credit. It's a powerful tool, but most central banks don't change it very often these days. It can be quite disruptive.
Okay. Then there are the tools we heard a lot about after the 2008 crisis, and especially during the pandemic, QE.
Ah, yes. Quantitative easing, or QE. That became a really big one.
Can you break that down? What is QE?
So QE is, well, it's kind of like open market operations on steroids, but with a slightly different aim. The central bank creates new money digitally, not usually printing physical cash, and uses it to buy large quantities of assets.
Not just short-term government bonds.
No, often longer-term government bonds, and sometimes even things like mortgage-backed securities, directly from the financial markets.
And the goal is?
The main goals are usually to push down longer-term interest rates, to inject massive amounts of liquidity into the system when short-term rates are already near zero, and just generally to encourage lending and investment during really bad times.
Like during COVID, the Fed did trillions in QE then.
They did. Massive amounts. And it arguably helped prevent a complete financial meltdown. But
There's always a but.
there's always a but. It also massively increased the central bank's balance sheet, the amount of assets it holds, and many argue it contributed significantly to the boom in asset prices, like stocks and housing, that we saw.
Right. And if QE is easing, putting money in, there must be a tightening version too.
Yes, logically enough, that's quantitative tightening, or QT.
How does that work? Selling assets back.
It can involve actively selling assets, yes. Or, more commonly, it means the central bank just lets the bonds it bought mature, and when it gets the principal back, it doesn't reinvest it. So the money effectively disappears from the system, and the central bank's balance sheet shrinks.
Pulling liquidity back out.
Exactly. Tightening financial conditions.
So they have quite a few tools, each with its own effects, pros, cons.
Definitely. And they often use them in combination. It's also really important to remember that monetary policy, what the central bank does, doesn't happen in a vacuum.
You mean how it interacts with what the government is doing?
Precisely. Fiscal policy, government decisions on spending and taxes plays a huge role. For things to work well, monetary and fiscal policy ideally need to be pulling in the same direction, or at least not actively fighting each other.
Yeah, you can imagine if the central bank is hitting the brakes with higher rates, but the government is hitting the gas with massive spending.
You get conflicting signals, less effective policy, potentially more economic volatility. Coordination, or at least awareness, matters a lot.
Okay, this is fascinating. Let's make it even more real. Can we look at some specific examples? How have central banks in different parts of the world actually navigated these challenges?
Absolutely. The U.S. Federal Reserve is always a key case study. We mentioned Volcker already. Since then, you've had periods of the Great Moderation under Greenspan, the response to the 2008 crisis under Bernanke, the low-rate era under Yellen, and now Jerome Powell navigating, well, first the pandemic fallout and then the big inflationary surge.
A real roller coaster. What about Europe? The ECB must have a different story, dealing with so many different countries in the Eurozone.
Very different challenges, yes. The ECB often had to worry more about deflation risk. the opposite problem, especially after the Eurozone debt crisis. And managing monetary policy for, 19 or 20 countries with varying economic conditions and independent fiscal policies, it's incredibly complex. Their strict focus on inflation sometimes puts them in a tricky spot regarding growth or unemployment in specific member states.
Let's jump to Asia. What about a major emerging economy like India? How does the Reserve Bank of India, RBI, handle things?
India's situation is really interesting. The RBI often faces this tough balancing act, needing to support strong economic growth to lift people out of poverty, while also battling inflation that can often be driven by things like volatile food prices or energy shocks, supply-side issues.
So their inflation might be less about too much money chasing too few goods and more about, say, a bad monsoon season.
Exactly, or global commodity price spikes. And standard monetary policy tools, like raising interest rates, are less effective against those kinds of supply shocks. Plus, they have to be very careful not to choke off growth, which is so critical for development. It's a very different kind of tightrope walk compared to the Fed or ECB.
That makes sense. And then there's the really unique case, Japan. Decades of deflation, right?
Decades. An incredible struggle with falling prices and stagnant growth. The Bank of Japan has tried basically everything, including massive QE and even negative interest rates for a long time, really pushing the boundaries of unconventional monetary policy, trying desperately to create inflation and break that deflationary mindset.
A completely different world from what most other countries have faced recently,
Completely, and then sadly, you have the cautionary tales.
where things go wrong.
Yeah. Countries like Turkey or Argentina, for example, have unfortunately provided ongoing examples of what happens when inflation really gets out of control, sometimes due to policy mistakes, loss of central bank independence, or external pressures. Hyperinflation, or just very high and persistent inflation, can be devastating, destroying savings, crippling the economy, and leading to social instability.
So looking across all these examples, what's the common thread?
The common thread is always that incredibly difficult balancing act. Every central bank, in its own context, is trying to control inflation without killing economic growth. It's a constant challenge with massive consequences.
Okay, so we've covered inflation driven by demand or costs and how central banks try to use their tools. But what about when inflation seems to come from, well, from outside? Big global shocks that the central bank can't really control.
Right, that makes the job exponentially harder. Their tools start to feel, well, pretty blunt in those situations.
The pandemic seems like the obvious recent example.
Absolutely. First, we had central banks cutting rates to near zero, launching huge QE programs, just trying to keep economies afloat during lockdowns. Massive support.
But then, as things started reopening,
We got hit by those unprecedented supply chain bottlenecks. Suddenly, it wasn't just about demand. The problem was getting goods produced and shipped. Computer chips, building materials, cars. Everything got stuck.
and that pushes up prices, but not really because of anything the central bank did or could easily undo.
Exactly. It's a supply-side shock. Raising interest rates might cool demand eventually, but it doesn't magically unclog ports or build new factories overnight. It can even make it harder for companies to invest in fixing those supply issues.
We've seen this kind of thing before, though, haven't we? Those external shocks driving inflation.
Oh, yes. The classic example is the 1970s oil shocks. Geopolitical events led to massive spikes in oil prices.
And that caused...
It caused stagflation, that really nasty mix. High inflation and stagnant economic growth. High unemployment. Central banks were really struggling then because tightening policy to fight inflation risked making the stagnation even worse.
And today, we still see things like wars or other geopolitical tensions messing with supply chains, right? Affecting energy, food.
Definitely. These war and geopolitical shocks are a major source of supply chain inflation right now. They disrupt the flow of critical goods, create uncertainty, and push up costs globally.
So when inflation is coming from these external supply problems, the central bank's tools just aren't as effective.
They're much blunter. It's like trying to perform delicate surgery with a sledgehammer. You can slow the whole economy down with rate hikes, and that might eventually curb inflation, but you risk causing a lot of damage, a lot of job losses in the process, potentially without even fully fixing the underlying supply problem.
Wow, okay. So bringing this all together after this deep dive,
Yeah.
what are the main things we should take away about inflation in central banks?
I think first, Just realizing that inflation is complex. It's not one simple thing. It has many potential causes, some internal to the economy, some external shocks.
Right. And second,
Second, that central banks have some really powerful tools to manage it, mainly interest rates, but also others like QE/QT. But these tools are imperfect, they have time lags, and they work better against some types of inflation than others. They're definitely not magicians.
it's not like they have a magic wand.
Not at all. And third, the ultimate goal is always this delicate balance, trying to keep prices stable without wrecking economic growth and employment. It's a constant tightrope walk.
And for you, listening to this, remember, you're part of this whole system. Whether you're saving money, borrowing money, spending it, looking for a job, these forces directly affect you.
Absolutely. Understanding even the basics of how inflation works and what central banks are trying to do can help you make more sense of the economic news and maybe even make better financial decisions for yourself.
It's definitely a lot to wrap your head around,
Yeah.
but so important. So here's a final thought to leave you with, something to chew on. Given everything we've talked about, the complexity, the bluntness of the tools sometimes, those big external shocks like pandemics or wars that seem to be happening more often, how might the actual role or maybe even the mandate of central banks need to evolve in the future? How can they ensure stability in what feels like an increasingly unstable world?
That's the multi-trillion-dollar question, isn't it? Something economists and policymakers are grappling with right now. There are no easy answers.